So, Felix, this is our last episode.
Our last episode. What a ride it's been.
My word. One of the things that I think our viewers aren't aware of is how much work you put into this last episode, Felix. We've done how many dry runs now?
I don't know about that. We've done one dry run. It was an interesting dry run that we had, but yeah, learned a lot of lessons through it. And yeah, we're very excited to actually be recording this for real this time.
Yes.
And
Felix on Captable's episode 3, season finale. Better than Game of Thrones season finale by definition.
By definition.
So let me just give a little bit of background before we hand it back to you, Felix. If you watched the first 2 episodes, we did equity, but the problem is a lot of things are now happening on safes or ASAs. And so one of the biggest challenges that founders have, and this literally first 2 episodes were a lead up to this episode, because this episode's the most ambitious in trying to help you visualize the impact that ASAs, safes, and convertibles can have on your cap table, and why it's prudent to think through this in advance of just giving away safes as if they were candy. So Felix has very kindly prepared for us for today's session a cap table, and this is not the way that you would set it up specifically, but for illustration purposes, this is going to be what we're going to do, and hopefully you get a lot out of this episode. Comment on the YouTube notes and in commentary if you found it useful, and reach out. So on to you, Felix.
Thanks, Carlos. And thank you once again, obviously, for doing this with me and for imparting some of your wisdom to whoever might be listening. And if you did watch our first 2 episodes, you probably realized that there was a bit of a break between the second one and this one. And a lot has been happening behind the scenes at Seedcamp. So we've had some new team members join. We've made a bunch of new investments that we are super excited about. We've had our first couple of companies go public from our portfolio. We've even got a new office, and we're all back in London, and we hadn't seen each other in the flesh in ages. And so, yeah, we're super excited to be back. And as you say, we are super excited to be recording this final episode of our 3-part mini-series on all things cap tables. As Carlos quickly kind of touched upon, in our first 2 episodes, we covered how to model a simple angel round. And then in the second one, we covered how to model a pre-seed round led by an institutional VC. So like a Seedcamp, and that was a straightforward equity round. And as he says, in this episode, we're going to be spicing things up a little bit. And so we're going to be walking through a seed round raised using a convertible note, which is one of the 3 very common variable price structures that we see today. And it's worth noting that everything we cover here today with convertible notes is completely applicable for other forms of variable price structures in the form of safes and ASAs. And the reason we're doing it with convertible notes specifically is because there are a couple more kind of moving parts with convertible notes than there are with safes and ASAs. And so really, if you can get it right with the more complex of the 3 cousins, the 2 will be much, much easier. So also another kind of disclaimer is that whilst we're not going to be building on the cap table that we built in the 2 previous episodes, a lot of the concepts that we covered in those 2 episodes, we're going to be elaborating on. And so if you haven't watched them, even if you aren't raising kind of like equity rounds or price rounds, it's still worth checking out, just because again, we're going to be elaborating on a lot of those kind of core concepts and terms. So to get straight to it, into kind of what we're going to be covering today, there are going to be 6 main points, and I'm going to quickly run through them just so that you've got an idea of the agenda. So number 1, we're going to briefly highlight the key differences between the 3 main variable price structures. So those are namely safes, convertible notes, and ASAs. Number 2, we're going to be walking through the actual conversion event of a convertible note. So what happens when you have different price per shares, how do those all convert, etc. And this is really kind of the bulk of the episode. Number 3, we'll walk you through what a secondary transaction looks like. So what happens when founders or existing investors sell a portion of their shares as part of a subsequent funding round. Number 4, we'll touch upon stacked notes and when that becomes toxic. And as Carlos has referred to it a few times, when a safe becomes unsafe. And then number 5, we'll be reviewing option pool expansions. We did cover this in the previous episode, but we're just going to touch upon that again and the implications of that when it's a convertible note. And then finally, we'll talk very briefly about the differences between pre-money caps and post-money caps on variable price structures. So there's a lot to cover. And with that, I think let's dive straight into the first point on the agenda. So why do we refer to convertible notes, safes, and ASAs as variable price structures? And what is the difference between the three of them? So Carlos does cover a lot of this in his book, The Fundraising Field Guide version 2.0. And he also talks a lot about it on Legal Hour, the podcast he did with our colleague Tom. And so in both of those, they really dive into the nuances of each and elaborate much more on all of them. But just for the purposes of this explanation, we're going to keep it high level. So firstly, the reason it's called a variable price structure is because the price per share associated with the conversion of the convertible note or the ASA or the safe is always going to be a function of a future event or condition happening, right? And so in this example here, obviously this is a kind of seed round that we're modeling. That future event or condition is likely going to be a Series A, which is i.e., the next round. And that's obviously because that is when the convertible note converts into shares and when the price per share of the conversion actually gets determined. If that's a bit confusing, we'll dive into it, and elaborate on that. So don't worry if you didn't get that. But that's really why we refer to some of these mechanisms as variable price structures. It's because they get priced in the future. So the three kind of high level differences between some of these, between a convertible, a safe, and an ASA are quite subtle. And I've tried to provide a little kind of cheat sheet here so that you can have a look at like the high level differences between them. But to actually like elaborate on that verbally. So starting with a convertible note, I mean, a convertible note is strictly speaking a loan that accrues interest over time. And that's one of the main differences between a safe, an ASA, and a convertible.
Felix, maybe this is a good point for me to give a little bit of the historical background and why it's evolved, because I think then it'll be easier to sort of understand why it has evolved. So, convertible note's been around for years as a structure, but it became popular during one of the previous recessions where the investors that were already invested in a company wanted to bridge the company, but not necessarily price it, and give optionality potentially to the company to be able to raise in the future from somebody else and or get their money paid back in some sort of debt. And so what's happened since then is that people saw that benefit of the speed that a convertible note can offer, but realized that frankly, nobody's going to offer as an equity investor debt to their company. So they little by little, as time has passed, people and lawyers and funds have been stripping away the bits of the convertible note that make it look like a debt instrument and are shifting it into something that looks more like an equity instrument with the benefits of the convertible debt that was the historical origin point of it. So literally you can think of the ASA safe as like the like sort of the grandchild of the convertible note. And so some of the stuff that you're going to walk through right now, Felix, as to what differentiates them is really a function of history more than it is any kind of like, reason that has to do with design. They weren't all born at the same time. And so you will see people using these interchangeably for different reasons. And one of the things that we talk about with Tom at the Legal Hour is that you shouldn't feel dogmatic about any one of these instruments. There isn't one that's better than another. They can all be crafted. So don't feel like you have to have one because it's the popular one. You can tweak them as necessary. And so think about it that way and choose the arguments that you have with your investor depending on what matters, not what structure it is. So on to you, Felix.
Thanks, Carlos. No, that's super helpful just to get the history lesson, because I guess that's where it's all born. But as you were saying, I think one of the reasons that convertible note is sometimes referred to as the jack of all trades is because what you're saying around the benefit of that note holders have, and that they can kind of benefit from the downside protection associated with debt lenders in the sense that they can get repaid with interest, but they also benefit from the upside potential that equity holders have because they have the option at the next round to actually convert that amount into equity. So as you'll see here, the other interesting thing about a convertible note is that it doesn't provide SEIS or EIS tax relief in the UK. And this is, again, Carlos, what you were kind of like mentioning now. And to then, transition into how an ASA was born, that was really made popular in the UK by facilitating EIS and SEIS tax relief for angels and specific kind of EIS funds. And so that stands for an advanced subscription agreements. It's not a loan, as you say, they're stripping back some of the features that were kind of like a hassle with convertible notes. And so it's not a loan, there's no debt, there's no repayment, there's no interest that has to happen. The SAFE over here is, that stands for Simple Agreement for Future Equity. It was pioneered by YC, so Y Combinator in 2013 as an alternative to convertible notes. And as you said, it's really interchangeable with what an ASA is in the UK. Now, again, just for the purposes of this example today, we're going to just be using a convertible note. And if it is an ASA that you're actually going to be modeling, it's just going to be simpler because you don't have some of these things that we'll chat about here, you know, around interest rates and so on.
Yeah, you just, if we start with the most complex one, then it can only get easier, right?
Yeah. If you can sprint, you can walk.
Exactly.
Cool. So let's get straight into it. We're going to set the scene. So you can see here that, you know, we have a company and we have 3 founders. They've already incorporated the company. They've allocated shares between them. So you'll see this 500,000 shares, 200,000 shares, 200,000 shares. They've also set aside 10% of the company here for an option pool. And now, you know, the situation is they've bootstrapped and they're doing really well, and they're going to go out raising a seed round of £3 million at a 15 million cap via convertible note. And just for the purposes of this, let's assume that they actually have that all kind of, they've got term sheets, it's all ready to go. So in this little table over here, you can see that we've broken the convertible note down into some of its different kind of constituent parts, right? And so you'll see that here there's a loan amount, which would be that 3 million that we just said. There's a discount percentage, and let's call that 20%. That's pretty kind of industry standard. The cap that we mentioned was going to be 15 million. That's don't know if it's quite industry standard, but in the market that we're in at the moment, it's definitely not completely out of the ordinary. And then we're going to have an interest rate. So let's call that kind of 5%. And over here, you'll see that this kind of, we're trying to work out, okay, how much interest accrues over this time period. And so in order to actually get a number there, you have to have a start date and an end date of the conversion. So let's go ahead and actually just put in a date. So sorry, I'm just going to type this in.
So while you're doing that, Felix, a couple of comments. One is the end date obviously is when it converts. So when you're typing this in, if you were just receiving this convertible note, it just wouldn't have an end date, right? Because you can extrapolate when there is a conversion event, what your total converted debt will look like. But until then, really, it's just a variable price structure, hence the name. Now, a few comments on the cap and the discount. The two things go hand in hand. I mean, at the end of the day, you know, let's just exaggerate it to make the point. But let's say somebody said, you know, I want no cap, right? You could get an argument with an investor about like, I want no cap. I want the convertible note to convert at the next round. Let's say the next round is 200 million. You went from a pre-seed company to a 200 million round all within a year. Like, let's just put that scenario out there. What would happen is that angel who would have potentially have, you know, calculated their ownership stake and their investment on the basis that you were going to raise at, you know, 10 million or whatever, they would have absolutely very small holdings. So basically it took all that risk on you early days and then they got nothing. So in exchange, they might ask for a cap, and that cap might be something where, like, if you exceed that valuation that they had originally agreed, at least they have like a stop limit on that. But also on the discount, there is a benefit if things don't go well, that they get a preferred price because they took earlier risk. So I just caveat that. We'll go into more detail on this at Legal Hour, but I caveat that so that while you're looking at these numbers, you don't think these are the numbers we're recommending. They're just a range, and you can play with these. Back to you, Felix.
Thanks, Carlos. And also just wanted to kind of flag here that so this column of this row over here, so total interest, this 300,000, you'll see in the, so we'll link the G sheet in the show notes, but there's actually a formula here that's just baked into the sheet, which essentially is calculating that value there. And so that's, as we were saying, it's like, okay, you've got 3 million as part of a loan, you've got there's a specific interest rate that's tied to that, there's a specific amount of time that's tied to that. How much interest accrues over that period on that amount. And then that's what this 300,000 is. And the reason we're looking for that is because the total amount that's going to convert is going to be the sum of that kind of initial principal loan plus the interest accrued, which is in this case 3.3 million, it's going to be that whole kind of batch that at the conversion event is going to convert. It's not just going to be that 3 million that you raised initially. This is again assuming there's an interest rate. In today's environment, it's not super common that there are interest rates, but that's just a kind of disclaimer. Cool. So we've got all the inputs that we needed. We've got this kind of total conversion value. So now that we've set the scene, let's move straight on to the second point of the agenda, which is the actual conversion event itself. And again, this is the kind of the meat of it. So the interesting thing about the conversion on any variable price structure is that it can come one of two ways, and it's going to be dependent, as what we said earlier, on the valuation of the next round, right? And the reason it can come one of two ways is that they're going to be two different price per shares that the convertible note in this case could convert at. So, and you're essentially as a founder trying to work out, okay, which one of the two is going to be most beneficial for the note holders to convert at. And so is it going to be the price per share that's associated with the cap, or is it the cap that you've pre-agreed on as part of that seed round, which in this case is 15 million, or is it going to be the price per share that's associated with the discount on the next round's price per share, right? And so in order to work out this price per share at the cap, because we've already got all these inputs, we've chatted about how to kind of calculate a price per share in previous episodes, but it's essentially this 15 million divided by the total number of outstanding shares pre the round. So we've got a value there, right? We've got 15.
In case you're wondering why there's a quick transition, it's because we made a little gaffe. But as with most recordings, the best things are when you make little gaffes. One of the fun things you'll probably notice is that in the previous bit, there was a number there, and now there isn't a number there. It's because we had left some numbers in there. So with that, just remember, keep calm, press delete, move onwards. So back to you, Felix. Where were we?
Exactly. So what we were saying is that essentially you're trying to work out which of the two price per shares is going to be most beneficial for the convertible note holder to convert at, right? And is that going to be the price per share that's associated with the cap that you've already agreed, this 15 million? Or is it going to be the price per share associated with the discount on the next round's price per share? And so you'll see in over here that there's actually a number. We can calculate what that price per share at the cap is because we already know what the cap is. It's 15 million. So in this case, we've covered this on previous episodes, but it's that kind of cap divided by the total number of outstanding shares pre the round. So it's 15, right? Yeah. And this is where the error came in on the last episode, on the last cut, was that there was a number here, is that over here, when you're trying to work out the price per share that's associated with the discount on the next round, we can't do that yet because we don't know what the next round is going to look like, right? And this is where we need to start hypothesizing on what the Series A could look like, because otherwise we don't know what we're discounting.
Yep.
So again, this is why it's called a variable price structure, because it's all going to be dependent on the valuation of the next round.
So you ready to showcase the next round?
So let's hypothesize on what a next round could look like. So we're going to unhide this. The reason we hid this is just because we didn't want to get anyone confused around what was going on. And if you've seen our previous episodes, you'll know that everything moves from left to right in terms of from a timing perspective. And so now here we are, let's hypothesize about what a new round could look like. So, all
right, drum roll, go for it.
Drum roll. Imagine things are going super well, right? And you're killing it, and you are going to be raising a Series A at a 30 million valuation, which is, a really good kind of very solid Series A to be raising. Again, sorry, this doesn't even have to be a hypothesis. This could just be, you have a term sheet from your Series A investors. You've got it all kind of very, very like solidly there. And you actually now this is where you can use your cap table to just do scenario planning. You can see exactly okay, based on this valuation, based on this round size, this is where everyone's going to end up on an ownership basis. So it's either a scenario planning tool, or you can just use it because that's actually where you are. So let's imagine a Series A investor is going to lead your round with, let's say, a £6 million check. You've then got another investor that's going to come in for a 1.8 million check. Ooh, not 18 million, 1.8. Boom. Cool. And so now you'll see that this number here, which was the price per share associated with the discount, you can actually calculate it. There's a number there because we've made an assumption of what the next round is going to look like. And so this is where the kind of the magic happens, in that because you've got these two price per shares, you're trying to work out, okay, which of the two is going to be preferential for those note holders to convert at. And obviously the answer is it's going to be the one that converts into more shares at the next round, which translates into it's going to be the lower of the two, right? Unless you have really, really stupid investors that don't want to do that. So that's where you can now see, okay, cool, we've got, that is going to be this preferred price per share. And now that we've got that, that is what we can start using when it comes to actually modeling out what everyone's going to land up with post the round. So I'm going to quickly put in these inputs. We have also just covered this in previous episodes, but you'll see here that to calculate the number of shares that the Series A investors are going to get, you're taking the amount that they've invested as part of that round, and you're dividing it by the price per share associated with that round. Same thing for Series A follow-on investor, divided by the price per share associated with the Series A. And now for the convertible investor, as we're saying here, this total conversion value, which is the sum of the principal plus the total interest, it's still the same 3.3. You're trying to work out, okay, how many shares are they going to get? And here the important thing to do is you take that number and you divide it by not the price per share associated with the Series A, it's this price per share that we've calculated, which is that preferential price per share that they're going to be converting at. And that's quite a common mistake that we see, is that even if you've understood, like, okay, there are two potential price per shares that they can convert at, this is what it's going to be, we still see quite a lot of people, when they model it out like this, dividing that number by that Series A number, that Series A price per share. So there you have it. That's the number of shares that the convertible note holders will have post the round. Again, this is when you can start playing around with the numbers, right? So assuming if you are doing scenario planning, let's say it's not going to be a 30 million Series A raise at a 30 million pre. Let's say it's going to be at a 18 million pre. So things haven't gone as well. And you'll see here that now, if it was in that scenario, the price per share that would be preferred wouldn't be the price per share associated with the cap. It would be the price per share that's associated with the discount on the next round, i.e. it's preferential for a convertible note holder to use a price per share that's 80%. So that's a 20% discount of this 18. So it's 80% of the 18, which equals 14.4. That's lower and therefore kind of better for them to convert at than it is at this 15 pounds, which is the price per share associated with the cap.
Yeah. So that's a good summary, Felix, of how tricky it can be for founders taking on quite a bit of convertible notes, is that you end up having all this outstanding unknowns. You know, you have, and I know that we had a different order here, but it might be a good point to talk about the safe unsafes, Felix, if you don't mind.
Take it away, Carlos.
It seems like a good point to do so.
Yeah.
So you just saw from this example Felix gave of how, for example, depending on the price, it'll affect the ownership stake of that convertible note. Because you don't necessarily know what your future is going to look like, one of the risks you run is that if you have one convertible note plus another convertible note, or, you know, safe, another safe, another safe. Again, I'm using those terms interchangeably. If you have one variable price structure plus another one, plus another one, plus another one, what you will see here is that you will have all these different scenarios, because each one of those safes is likely going to be on a different cap, on a different discount. Not only do you have the complexity of modeling it out as a problem, is that, as you can see here from the new investor, there's a displacement of equity in the new round by the convertible conversion. So that displacement means that the new investor doesn't get the full ownership that they might have gotten had they been the only participant in the round. So the more convertibles you have relative to the new money coming in, the harder it is for that new investor to be able to get their ownership stake, which means you're less appealing to a new investor, because if you have, let's say you had 10 outstanding safes, 10 outstanding convertible notes, there'd be so much conversion necessary that it would be toxic to the cap table at the conversion event. And I lived through this with one of our founders, and it was really painful because none of the convertible note holders wanted to convert. So there was very little motivation to do so because they were all in different terms. So it was not easy. What's that expression, Felix? Rallying cats. Like it was not easy to get all these people to agree on an event that could convert together to keep it clean. So on top of that, new investors were put off by all this outstanding convertible note safes and everything. So the point of it is that the safe and the convertible and the ASAs are wonderful instruments if used well. But if used in excess or in beyond their scope as a bridging instrument, or perhaps as a single round instrument, you then start creating a situation where they become unsafe. So back to you, Felix.
Thanks, Carlos. That's super helpful. And I was just, whilst you were speaking, I just made a quick thing here showing that the percentage of the round that would be taken up by the total conversion value. And here's to illustrate kind of what you're saying. It's like if you make that 5 million, very quickly you've got 41% of the new round that's essentially being taken up by this convertible note. And so that, to your point on kind of ownership requirements for Series A investors, etc., I think that kind of highlights it. Cool. So that's the conversion event. That's the main bit. But another thing that we wanted to talk about on the agenda, the third point, was around secondary transactions. And so this is something that, especially in today's funding environment, is becoming more and more prevalent in the early stages, in early funding rounds. And typically it used to be a little bit more prevalent in kind of later rounds. And really the point of it is to give existing shareholders, be it existing investors or founders or early employees, liquidity. So essentially they can sell a portion of their shares and in exchange for cash, obviously. So in this example, we're going to assume that this investor B over here wants to take part in this round, but there isn't any space. And so the founder has agreed to do a secondary. So essentially selling a part of their shares in exchange for cash. And so again, for this example, let's, for simplicity's sake, assume that investor B is going to want to put in £100,000 worth of shares, right? And so what we're going to do here to represent it is we are going to calculate the number of shares associated with that 100,000. So it's going to be the amount of money that he's putting in, or she is putting in, divided by the price per share associated with that round. And you'll see here that we put it in this column, this ordinary share column, and not the preferential share column where we'd kind of like worked all these other shares out. And there's a reason for that. It's because assuming investor B is purchasing shares from founder one, you'll see over here that founder one is a holder of ordinary shares, not preferred shares. And so if you're buying ordinary shares from founder one, you're going to land up as investor B with ordinary shares. And so it's really, really important to delineate the different types of shares, right? Here you'll see preferred shares, ordinary shares, options, etc. If we hadn't done that and we had just one column where we said shares and we grouped them all together, the problem with that is that very quickly you can lose track of who owns what rights are associated with what shares, etc. So it's a really, really important point. Like, be sure to delineate between the different types of shares and make sure that whenever you're, obviously, for example, in a transaction like this, just make sure that whoever's buying shares from whoever else, that's all kind of represented accordingly in this table. So that's just on the kind of like ordinary shares versus preferential shares. The other thing to bear in mind here is that obviously because investor B is buying £100,000 worth of shares, so 3,333 shares, founder one, that's going to be represented as the equal but opposite, right? Like they are going down the amount that investor B is going up. And so over here, we would just say equals -1 times, and then it's the same formula. So it's just going to be this 100,000 divided by the price per share. And there you have it. So investor B goes up the amount that founder one goes down by.
Yeah. So on that point, Felix, one of the things that's probably worth noting is that what we've done here is mathematically illustrate the transaction between one investor and one founder. That could be between two investors, can be between another founder And it doesn't necessarily mean that it has to be all in ordinary shares. You can do just about anything. This is effectively a commercial transaction between one party on the cap table and another. And provided that both parties have permission, according to the shareholders agreement, to do the transaction, pretty much everything is possible. In other words, I've seen things where like an ordinary share becomes a preferred share as part of that transaction, or vice versa, or there's restrictions put on the purchased shares. So think about this as an illustration of the mathematical possibilities of a secondary rather than like a recommendation or like the only way it can happen.
Yeah, exactly. Thanks, Carlos. Cool. So fourth point of the agenda was these kind of like stack notes and when safe becomes unsafe. And obviously we've chatted upon that about that already. So let's move straight to the fifth point, which has to do with the option pool expansions. And again, we actually have covered this in previous episodes, but just going to reiterate because it's really common to happen in any of these kind of like early stage funding rounds. And essentially you'll see here that, even though you might have had an option pool already set up, in this case, there was an option pool set up of 10%, as part of, I guess, like the incorporation of the company. After the convertible and the kind of round that happens, that gets diluted down to set over here. You can see it's 6% post the round. And what's pretty typical in some of these Series A rounds is that your Series A investor is going to ask you to top up the option pool. And the reason they're doing that is obviously because they want you as founders to be able to incentivize top talent to join, to execute on the goals that you've set out, which they've given you capital for. And so again, a typical setup would be that a Series A investor would ask you to top that up. It doesn't necessarily have to be 10%. And again, like we're not going to kind of take a position on what that looks like, because that's really dependent on a multitude of different factors. But so for this example, let's just hypothetically say that you agree to set up post the round, you want to have an option pool of 10% in total, right? So you want to essentially like make up a 3.24 difference here. So the way we've set this up here, and again, if you haven't checked out the previous episodes, do so, just because we kind of elaborate on how to actually set this up. But you would put in your 10% option pool. You can see here that your option pool target, rather, you can see that the delta, which is the amount that you're short on, is 3.24. And then the way we would actually model this in the cap table is you would say the option pool delta, so the amount that you're wanting to make up for, times by this number over here, 0.17, which is the total number of shares post the round, right?
Before you hit return.
Oh,
don't worry about it. Press delete. Show everyone how to set up the sheet so that you have recursive calculations, because if you don't have it on, what might happen is that you get a whole bunch of errors.
Okay. We've done this in previous episodes.
Exactly. If you're watching this as your only episode, you're going to want to do this. It's going to have spreadsheet settings.
You're going to have to bear with me if I get spreadsheet settings. Here we are. Spreadsheet settings, calculation. You then go on to
iterative calculation on. So if you're getting mistakes on your math, where it says like not available or something like that, it's because that is off. You need that on.
There it is.
So back to where we were, Felix.
Back to where
multiplying the amount of options you want by the total.
Exactly, by the total post the round. There you have it. So now you can see that essentially you would top up a little bit more pre the round, meaning that at the end of the round, once that Series A comes in and dilutes that option pool a little bit further, these two numbers together make up 10%. So you can see
and this is why we've created this ESOP expansion 2 and 3 little rows here, because they're there mostly to help with the math. It's not like you have two separate ESOPs. They're just there to help showcase the increments. You can then like group those cells together if you want or whatever, but it's good to be able to, like, especially when you're debugging your cap table and you're like, where's this error? You can see, the error is because I screwed up the expansion rather than the other one.
Yeah, exactly. Cool. So that was the kind of penultimate point on the option pool expansion. The last thing we wanted to touch upon was around the pre-money versus post-money valuation caps on variable price structures. And so really the mechanics here are quite similar to a priced round, in the sense that if founders and investors agree on a pre-money valuation or a pre-money cap, then an investor's ownership is going to be a function of A, the size of their investment, B, the pre-money valuation of the round, and C, the actual size of the round or the amount raised on that note. Whereas if it's a post-money valuation or a post-money cap, the ownership is going to be a function of A, the size of the investment, and B, the post-money valuation, and it's going to be completely irrespective of the size of the round. And so one of the big advantages that comes with having a post-money cap is this ability to calculate immediately and precisely just how much ownership of the company has been sold. And so that's obviously super important for founders, because it's obviously really important for them to know the dilution that they're taking on. But it's also fair on investors, because if you're buying in on a new round, you want to know roughly what your investment is going to get you. And almost like kind of historically, what happened, something just for context, is that YC, so Y Combinator, started off initially with pre-money safes. And then in 2018, they released the post-money safe as an alternative. And what was happening was that pre-2018, a lot of the convertibles being raised or safes being raised were much smaller rounds, and there would typically just be one kind of amount being raised on a note. And to Carlos's point, it wasn't, in today's funding environment, we're often seeing A, much bigger rounds being raised on convertible notes, and B, we're seeing the potential of these stacked convertibles happening, right? And so all that translates to is that in an environment where there's more money being raised on notes and potentially on different notes, post-money caps is just a much clearer and simpler way to digest the ownership of a company.
Yeah. So with Felix's point, the post-money caps have now become like seat belts. There was a time when cars had no seat belts, but now most of them do. But just to be safe, make sure that you double check to see that you have a post-money cap on your recent terms. So with that, guys, that is the epic conclusion.
That's it.
Final episode of this mini series on Felix on cap tables. Thank you so much, Felix, for putting in a lot of the hard work in building this model. We're going to be sharing this model along with other ones online, and hopefully you guys, if you find it useful, share it with other founders that I think would benefit. One of the things that I used to say, and now with all these tools that build cap tables for you, I'm going to continue saying it. I'm actually going to triple down on saying it, is if you're not building your own cap table, you run the risk of not knowing exactly the impact something might have in the future. And therefore, try not to rely on third parties or on tools, and you start losing. So you don't lose this granular feeling for what a round might do to your equity. So with that, guys, I'll pass it back to you, Felix, to say goodbye.
Bye, guys. Thank you for tuning in, and thanks again, Carlos, just for doing this with me. It's been a lot of fun.
It's been a lot of fun. All right, we have more stuff coming soon down the pipe. Stay tuned, guys. Bye.
Cheers.